Hello, good afternoon, everyone. I'm Kyle Hill, one of the partners here at Diversified, and I'd like to welcome you to the next installment of our Wealth Webinar series. This is the mid-year economic and market update. Per usual, we'll look to keep this about 30 minutes so you can get back to your day. So if you have any questions that aren't answered today, please reach out to us by phone or email, and we'll be happy to answer those questions for you. So without any further ado, I'd like to welcome our speaker, Mike Horwath, our investment specialist here at Diversified.
Thank you, Kyle. Welcome, everyone. I appreciate everybody taking the time out of their day here to hop on for about 30 minutes. We've called this the mid-year market review. In the end, we usually like to meet twice a year, get together twice a year to review the previous 6 to 12 months, if you will, what's happening in markets and the global economy. So today's an interesting day to do it. I guess the past couple of weeks have certainly brought some fun to markets, but let's dive on in. We're going to start really where we have the past few webinars, and we'll start with a general market update, what's happening kind of in the global economy, asset class returns for the first 6 months of the year, and really talk about even the last month and a half. I'd also like to dive a little bit into equity and fixed income individually, and it's really actually it's a major headline today. It's been a talk for the past several years, but the question we get quite frequently is Dave, Kyle, Andrew, when's the next recession going to hit? Right? I think people have naturally become a little bit skittish, especially with 2007 to 2009 still being fresh in our minds. We're 10 years into really an expansionary cycle, a bull market, if you will. So what do we need to do? What should we be doing? Our stance is still that recession risks, while they are rising, and you've seen they're dominating headlines today for various reasons, they're still relatively low, especially in the short term. I think, and we'll discuss it, there's certainly concerns moving forward that we need to be aware about. There are indicators that have turned negative, which are primarily what are driving today's markets. But we'll talk about that for a little bit, and then we'll just wrap it up with a summary and economic outlook. So I like to focus a little bit on the right-hand side, especially the gray bar. So the gray bar is year-to-date through the first 6 months of the year performance for major asset classes in the global market. The top 4 here represent global equity markets. So that's U.S. large cap stocks, small cap, developed international, and emerging international. Everything below that are fixed income, and then down here are commodities. But the gray bar represents the first 6 months of the year. And clearly the common theme is a lot of positive. So we've seen over the last 6 to, I guess now it's 7.5 months, we've seen some pretty strong markets. Now, taking a step back, and from the last time we spoke back in February, we discussed the volatility of the fourth quarter in 2018. Leading up to the fourth quarter, September, early October, we saw markets hit their previous highs. And in the fourth quarter, we started to see some market volatility driven a lot by concerns over trade tensions and concerns that the Federal Reserve was still pretty firm on their stance to hold rates steady, if not continue raising rates. If you recall, they raised rates 4 individual times in 2018. By them raising rates, that's usually designed to slow the economy, slow the transfer of money throughout the market. Coming into 2019, that stance flipped. They started easing on that stance of raising interest rates to now saying we're open to holding them steady, if not reducing interest rates. And that's what we saw last month in July when the Federal Reserve decided to reduce interest rates by 0.25%, somewhat unwinding some of their stance from 2018. We also see markets anticipating a further rate cut. I think at this point, markets have priced in a pretty much 100% guarantee that rates will be cut in September. The question now becomes, will it be a 0.25% rate cut or a 0.5% rate cut? So what's the magnitude? It's almost all but priced in at this point. But with that as a backdrop, the volatility in the fourth quarter, especially like for U.S. small cap, for example, U.S. small cap was down 20% in the fourth quarter. We've seen a nice bounce back within, U.S. small cap and really equity markets in general for the first 7.5 months. Even despite the volatility of the last month and a half, through yesterday, obviously today notwithstanding, U.S. large cap was still up over 8% or 18%, year to date. Another interesting topic, and we just mentioned about rising interest rates in 2018. 2018 was a tough year for fixed income. Reminder, fixed income and bonds we use as a more stable piece within our portfolio, used for income, used for stability and diversification away from stock market risk. So we saw in 2018 a very tough environment with 4 individual interest rate increases, a pretty tough environment to where the Barclays aggregate, which represents kind of the U.S. bond market, was only up 0.01%. It was still positive, but essentially for all intents and purposes, flat for the year. This year, rates have come down dramatically, and that's a lot of what's indicating these indicators today for recession risk is that rates have been pushed down extremely far as a flight to safety has occurred and concerns over global or really U.S. recession moving forward. And we'll discuss that a little bit here coming up. But as interest rates drop, bond prices rise. That means people are paying more and more for individual bonds, and they're yielding less, but bond prices are increasing now, and ultimately your fixed income returns are positive. So we've seen a pretty strong fixed income market from a return standpoint. It's been pretty volatile, but from a return standpoint this year. So if you're a diversified investor and you look at this chart, pretty much everything in your portfolio is working for the first 7.5 months of 2019. Going into equity markets specifically, I really just want to focus on this top right chart. So these are those 4 asset classes that we had just mentioned at the top within equity markets. So Russell 1000 refers to U.S. large cap. Small cap is Russell 2000. The EAFE is international developed, right? So big international countries, Germany, the UK, Japan, etc. And then emerging markets, as you know, the BRIC countries, Brazil, Russia, India, China, as examples. That light bar represents a 1-year return. So 1 year captures the second half of 2018 and the first half of 2019. And despite the volatility we saw in 2018, especially at the end, we've seen positive returns within U.S. large cap above 9% going back over a 1-year period, but positive over 9% for U.S. large cap over 1 year. Positive returns in international. So international was also down in the mid-single digits, high single digits in the fourth quarter. We've seen the returns this year take that into positive territory. So by and large, we've seen a lot of these asset classes recover from the pullback we saw in the fourth quarter, and even so, still performing well over the last month and a half, despite more volatility coming into markets. The common themes are U.S. large cap is beating U.S. small cap. I think that's something we probably would anticipate will continue. We would favor large cap over small cap ever so slightly right now, just because as a flight to safety happens, large, stable, more mature companies tend to have a little bit of advantage over, smaller, less nimble companies will. We also see U.S. outpacing international by and large. There's been, certainly some volatility internationally as, trade tensions between the U.S. and China really ripple throughout many other countries. Germany is in the headlines today because Germany posted a negative GDP growth, so their GDP contracted in the second quarter. So technically, if they have a third quarter where GDP contracts again, that's technically a recession. Germany is a very heavy export-laden country, so trade tensions are going to wear on a country like that, similar with something like a Taiwan or a South Korea, countries that are heavy manufacturing, heavy export. So it does have a rippling effect through the economy. But by and large, you look at this chart, you see U.S. large cap continues to lead the pack, still positive over a one-year period, and international markets, relatively flat over a one-year period. So diving into fixed income, and in this top right chart, this is what's referred to as the U.S. yield curve. So it's actually, I always put it here, but I think today more than ever, it's getting a lot of headlines because an inversion has taken place. And we'll go through that in a second here. But normally, so a year ago, this green line, this is a more normal shaped yield curve. So as you go out and farther out on a yield curve, so the farther the maturity, you typically yield higher amounts from your fixed income, right? You're compensated for being a longer-term investor within fixed income. A 30-year bond will yield more than a 2-year bond, right? That is traditional yield curve shape. Now, it's pretty flat here. Normally, I guess you would typically say steeper, but this was 1 year ago. Fast forward to June 2019, this blue line now represents what the yield curve looks like now. You can see at different points in the curve, there is an inversion taking place where some of these intermediate term rates have been pushed down so far that these short-term rates are yielding higher than the intermediate term rates. The concern that the general public has is that this type of inversion has was a precursor to many recessions previously. Now the hard part becomes this tends to be a precursor to a recession, and it can be 12 to 24 months. There's no defined correct time period to where a recession would take place. So I don't think it's necessarily a sign that you have to get out of the market. I think similar to what we would have said a year ago, there just needs to be caution and diversification and understanding of where our risks are. But as interest rates fall, as I mentioned earlier, bond prices rise. So as you can see down below, if you have fixed income in your portfolio, as many investors do, if you are a diversified investor who doesn't want to be 100% in the stock market, this is a good way to generate higher returns than cash, but still have relative stability in your portfolio. You can see returns are anywhere from 4 to 8, 9, 10%. Here are U.S. Treasuries, corporate bonds. You see over here high yield bonds, but by and large across the board, the green line represents year to date through the second quarter, positive across the board. So why do we say recession risks are still low for 2019? And it's kind of it's an interesting headline, based on what's happening today. But in the short term, I think it's important to understand what's happening and what the U.S. economy looks like today. Now, there are certainly risks, and there are risks that can accelerate a recession, and we'll discuss those in a minute. But if you look at the relative health of the U.S. economy, unemployment is still extremely low, right? If you look globally, this shows the Eurozone, UK, US, and Japan, unemployment since really 2002, but you can see the peaks of unemployment going back to the Great Recession. Everything has continued to drop over the course of the last 5, 7, 8 years. The US, while it says here 3.8, the most recent reading I saw was about 3.6% unemployment, a very strong number. So people are working. Additionally, and a very important note is inflation is pretty much on target for what the Federal Reserve pegs its target at. They usually say about 2% is what their target is. The most recent reading was, over the last 12 months, a 1.8% inflation number. Why is that important? The biggest tool that the Federal Reserve has to mitigate rising or high inflation is to raise rates. The fact that inflation remains below or at their target speaks volumes that they will be likely to continue keeping rates as is, if not reducing rates, which would help the economy in general. And as we're talking about now, the Federal Reserve is open to reducing rates. A big part of how strong the first 6 months have been is because of the rhetoric the Federal Reserve has used about being open to reducing rates. They did it once in July. It's extremely likely they'll do it again in September. Not sure if they'll do it again in 2019, but it's likely if they don't do it one more time in 2019 that there'll be one more rate cut probably in 2020. But that's a fluid situation depending on trade tensions, trade negotiations, economic data. That could accelerate rate reductions. It could force them to hold rates still. And it's something that, is really data dependent and market sentiment related. And the last thing I like to point out is market valuations are pretty fair. They're not excessive. If you recall, the bubble of 2000, the tech bubble, was caused because asset prices, especially within the tech sector, had risen so astronomically high, and these companies weren't making money, right? So when you look at valuations of the economy and say, versus what earnings are being generated by the companies within the U.S. and really globally, based on current prices, are they overvalued? Are they undervalued? The U.S. is not undervalued by any means, but it's pretty fair to say the U.S. is fairly valued, especially relative to the last 20-25-year average. And that holds true pretty much across the globe, and we're seeing pockets, especially within emerging markets, of relative cheapness, if you will. Not that they're extremely cheap or beaten down, but emerging markets right now appear like a good value. Now, you have to take into consideration trade tensions, may hold off on going heavier emerging markets, and we would advocate for holding off making that call. But by and large, when I say, is this recession going to be due to 10 years of a growing economy, I'd say no, because in the end, relative valuations aren't that high compared to the last 20-25 years, right along the average. So it'll need to be caused by something else. And that something else, and if you look on the right-hand side, is, and this is really the major concern, is just trade negotiations, right? Trade negotiations ripple across not only the U.S. and China, but the global economy, as it's a very interconnected global economy, a lot of export-heavy countries. And when demand from import-heavy countries reduces, manufacturing slows down, and those economies can really be hit hard. And we're seeing that with Germany, whose auto business is now slowing, and that's such a major part of their economy. So the concerns moving forward from an outlook perspective are still, we have to be careful with the trade wars, the trade negotiations, until that is figured out, which likely won't be until after the next election. That's something we're certainly keeping an eye on, and certainly something that's going to move markets one way, similar to yesterday, where markets move forward pretty heavily because of positive trade talk, versus today where it's pulling back. It's not necessarily due to trade, but it's all interconnected. I'd also point out, a concern is investor sentiment's lacking. I think investors since 2008 are on pins and needles as to, it's too fresh in their minds as to markets and the volatility that can happen. A lot of investors were scared to get back in the market coming out of 2009. Now we've seen 10 good years, but it's still fresh. So the investor sentiment, I think investors are worried, and I think they're a little bit quick on the trigger to pull back their equity risk due to that still being a concern. On the flip side, from a good standpoint, rate cuts are going to help. Holding rates steady and not raising rates like the Federal Reserve has done so far this year will help, and rate reductions will at least help the economy. And the fact that the Federal Reserve is open to doing so is a good, positive thing, especially during a time where trade negotiations are so high. Equities are still a good value, especially relative to bonds. We talked about how bond prices have risen. If you compare the value of a stock versus value of bonds just in general, right now equities, stocks are actually a better value for what you're yielding versus bonds. Bonds are very overvalued right now. Investors have flocked very heavily towards those safe assets. And we do see pockets of relative value where emerging markets is a great example, where if negotiations start to improve, if they come to an end, comparatively, they are pretty cheap. And I think there's areas where over time, and we'll continue to evaluate this, is where can we find value within the global economy? Emerging markets is one, and really, in general, markets aren't overvalued. They're fairly valued at this point. So I think that's something on the positive side moving forward. So we tie this talk about recessions and potential recessions and when do we get out or how much risk do I take, and taking a step back, our philosophy, it's in our name, it's something we fully believe, is diversification, right? Diversification, this is called the quilt chart. It shows asset class returns each calendar year. And you can see it constantly changes. And there are constant studies done about, should we buy last year's best performing? Should we buy last year's worst performing? Or should we just stay diversified? And almost every study will come out and say, over time, your best bet is to continue being diversified and being allocated depending on the risk tolerance and your ultimate goals. So we always like to remain diversified. And when equity market risk picks up like this, to me, this chart speaks volumes. And it's a little bit busy, but this really represents holding period returns for the S&P 500. So the S&P 500 is an index that represents the 500 largest U.S. stocks. In the end, what it represents is, since 1930, holding period returns from short time periods to longer time periods. So this top left shows if you were to hold since 1930 through the end of 2018, 1 month holding period returns. So every single month, what do returns look like for the S&P 500? And you do the same thing if you hold it for a year. So these are calendar year returns. This is a 5-year holding period, 10 and then 15 down here. So 15 would represent holding it from 1930 to 1945 and then 1931 to 1946. And what you see, and this is why it's so important to take a step back and remind yourself, what are we using the stock market for? The stock market is used as the growth engine of our portfolios to provide us growth for retirement. It's going to help us fund future income in retirement. It's going to help us grow our assets for legacy purposes, whatever that reason, and those are all reasons that we currently use it. Those goals all tend to be long-term. And if they're not long-term goals, we're not using very risky stocks, or we're not going to be very heavily allocated to stocks, because look in the top left, in any 1 month since 1930, the S&P 500 has only been positive 60% of the time. It's almost a coin flip for any 1 month to be positive. It doesn't feel as safe. It doesn't feel very comfortable knowing that. But when we go out farther and farther, you start to see these numbers pick up, and there has never been a 15-year period, holding period, since 1930, where the S&P 500, by the end of that period, hasn't been positive. That's what we always talk about with stock market investing, being patient, understanding why we're invested the way we are, and what we're using that specific part of our portfolio for. We have fixed income. We have bonds for the more stability-focused piece. And this is not to tell you that it'll never be a negative 15-year holding period, but it's to say, look at the probability historically versus what we see over any 1 month holding period. I always like to end with a quote. I thought this one was really helpful. Benjamin Graham was a famous investor from back in the early 20th century. He wrote a couple books on value investing back in the 1930s and 40s. But this quote still speaks volumes today, and he said the best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. And I think behavioral discipline is very important. We all sit here and we go through financial planning and understanding what we need to do to get to our ultimate retirement goals or income in retirement. We talk through the plan and the rate of returns, but I think it's easy to derail our plan if we don't remain behaviorally disciplined and learn from past investing mistakes. So if you ever have any questions, that's why we're always here. Please reach out to Dave, Andrew, or Kyle. We're always happy to answer any questions, concerns. We'll be happy to circle back and get you an answer ASAP. But I appreciate everybody taking the time today to hop on this webinar. I hope I answered majority of your questions, and if I did not, please don't hesitate to reach out to Dave, Andrew, or Kyle. We're always happy to answer those questions. I'll be back in February on our recap of 2019, but until then, I hope everybody has a good day and a good end to 2019.
Thank you very much, Mike. And as a reminder, we did record this webinar, and we'll have it posted on our website for easy access. So please, if you want to give it another listen, feel free to do so. Or you may also obviously share it with anyone that you would like, that you think might find value in it. And then lastly, please save the date for the next in our webinar series, which will be on October the 9th at noon. Thank you again, everyone, for listening in.